Over the past few years, one of the most fascinating shifts in Bitcoin adoption has come from an unlikely corner of the financial world: corporate treasuries. What started as a bold experiment by MicroStrategy in 2020 has evolved into a broader trend. As of July 2025, it's estimated that between 134 and 145 companies now hold a combined total of around 855,000 Bitcoin. That is roughly 4% of Bitcoin's total supply. And to put that into perspective, MicroStrategy alone holds 597,000 Bitcoin, making up over 70% of all corporate Bitcoin reserves. Clearly, corporate adoption is no longer a fringe idea. For Bitcoin enthusiasts, this development can feel like a win. It's a strong signal that Bitcoin is no longer just a tool for ideological cypherpunks or tech-savvy investors. It's becoming a core component of institutional financial strategy. But not everyone is cheering. With corporate adoption comes a set of new dynamics, okay? Increased price influence from boardroom decisions, custodial concentration, and the looming possibility of mass sell-offs during bear markets. Oh boy, that is my favorite topic. There aren't abstract risks. They shape the future of Bitcoin ecosystem and the experience of everyday users. So in this video, we're going to take a balanced look at what the pros and cons of companies adopting Bitcoin as a reserve asset. We will break down why this matters, who's doing it, and what the data shows, and what every crypto enthusiast should keep in mind, especially as we move deeper into this new phase of institutional participation. Okay, let's get into this. There's no question that corporate adoption of Bitcoin comes with serious implications, some encouraging, some more complicated. Let's start with the upside. First, Bitcoin's legitimacy is strengthening. When major companies start putting Bitcoin on their balance sheets, it sends a powerful signal to markets, regulators, and the public. This isn't just about some internet magic money anymore. It's being treated as serious strategic asset by some of the most recognizable names in business. And this trend is accelerating. In just a few years, the number of public companies holding Bitcoin has jumped from around 20 in 2022 to over 60, possibly as high as 124 depending on how you count it. That growth has been supported by macro tailwinds like the US Strategic Bitcoin Reserve announced in early 2025 and over $43 billion in ETF inflows just in Q1 of this year, with BlackRock leading the charge, as you probably already know. So what this means is greater liquidity, deeper markets, and potentially reduced long-term volatility, which some of you would love. The more Bitcoin is embedded in the global financial system, the harder it becomes to ignore, okay? So the second thing is Bitcoin is being used as a hedge and a way to diversify treasuries. We're now 5 years in an era of aggressive monetary expansion. Since 2022, the US M2 money supply has ballooned over 40%, while inflation has consistently outpaced bond yields. If you've been watching this show, you know that already. So that creates a dilemma for corporations: leave excess cash idle and watching its purchasing power erode, or take a calculated risk on harder assets. Bitcoin, with its fixed 21 million supply and resistance to inflation, has become an appealing option, all right? Companies like Mercado Libre have used Bitcoin to hedge against their weakening national currency. And in this case, Argentina peso, which lost over 50% of its value in 2023 alone, they're loving this. MicroStrategy, of course, is the poster child. Its initial $250 million investment in 2020 has ballooned into over a $55 billion of holdings today. And that's not just a balance sheet number. It's become central to the company's identity and market value. Third, there's a real financial upside. MicroStrategy's stock, for example, surged over 350% in 2023, outpacing Bitcoin's own performance, largely because of its aggressive accumulation strategy. Shareholders now view the company as a proxy for Bitcoin exposure, and in bull markets, that has paid off handsomely. And it's not just holding coins. Companies with strong credit ratings can issue debt, usually in the form of convertible notes, to buy Bitcoin. MicroStrategy has done this repeatedly, allowing it to leverage into Bitcoin during favorable market conditions. With an average purchase price of around $70,000 per coin, at today's price sitting at roughly $109,000, the company is sitting on nearly $14 billion in unrealized gains. Fourth, there's a branding benefit here. In a world where innovation matters not just for the product development, but for investor sentiment, holding Bitcoin can be a reputational asset. Companies like GameStop and Rumble have announced Bitcoin reserves in 2025, and it was met with enthusiasm, especially from the younger crypto savvy investors who view these moves as something that's very smart and a sign of moving forward in their thinking. On platforms like X, these announcements trend almost immediately, driving both engagement and price action. In the short term, that can help boost stock prices and visibility, but as we'll discuss later, it also raises concerns if Bitcoin is being used more for marketing than long-term strategy. And that's going to help with the bear market here coming up. But not yet. Okay, we're not in a bear market yet. Still, the core advantages are real. Bitcoin is proving itself as a legitimate, high conviction treasury asset. It offers upside diversification and an increasingly respected place in corporate finance. Of course, no trend is one-sided, and corporate adoption has a flip side. Let's take a look at those risks. As bullish as corporate adoption might seem, it's not without its risks, and in some cases they're substantial. Bitcoin may be maturing as an asset, but the environment around it is still volatile, politically charged, and operationally fragile. Let's break down some of its biggest concerns that at least I have right now. First, there's the issue of volatility. Bitcoin's long-term trajectory has been impressive, but its short-term swings can be absolutely brutal, as you all know. That's just part of the game here. We've seen 50, even 70% drawdowns in a matter of months. Just look at 2022 when Bitcoin crashed from $69,000 to $16,000. Companies with high exposure, especially those that leverage debt to buy it in, could face serious balance sheet pressure, and they're definitely going to feel that. MicroStrategy, for example, carries $4.6 billion in convertible notes, much of which was used to fund its Bitcoin strategy. As long as Bitcoin remains elevated, that looks smart. But in a downturn, that kind of leverage becomes a liability. And that's not theoretical. Tesla famously sold 75% of its Bitcoin holdings in 2022, citing liquidity concerns. They weren't alone. As of 2025, nearly half of corporate adopters have an average entry price of about $90,000, which means it wouldn't take much of a pullback to wipe out billions in unrealized gains. And that will happen next bear market, guaranteed, all right? But before that, Bitcoin's correlation with broader market assets also matters, all right? So when markets sell off, Bitcoin tends to go with them, which limits its usefulness as a hedge, especially when companies need liquidity the most, all right? Second, custodial and cybersecurity risks are still underappreciated. Most corporate holders aren't storing Bitcoin themselves. They're using third-party custodians. Oh my gosh. All right. So Coinbase Custody, for instance, manages around 30% of institutional Bitcoin, with BitGo and Fidelity also in the mix. That centralization creates risks. Okay, it does. I promise you. If a major custodian suffers a hack, data breach, or operational failure, the impact could be systematic. Think about how exposed the ecosystems become when the same hand of custodians are responsible for tens of billions in Bitcoin. On the flip side, self-custody isn't simple either. Losing private keys means losing access forever. And while crypto-native firms might understand that risk, many traditional companies don't. I would say most of them don't. Historically, around 20% of all Bitcoin is estimated to be lost. 20%, often due to user error. Third, regulatory risk is always looming. The current political climate in the US is unusually pro-crypto. We've got the strategic Bitcoin reserve, we've got the spot ETFs, and we've got regulatory framework that, while still messy, is at least moving forward, okay? But that could change, and the 2029 election is already on the radar for Bitcoin holders. Oh my gosh, like guys, enough of this. A different administration could easily reverse the course, reclassify Bitcoin holdings, impose punitive taxes on unrealized gains, or even order the liquidation of government reserves. Yes, that is possible, all right? Internationally, the picture is even more fragmented. China's ban is still in effect. The EU is navigating MiCA, and emerging markets remain largely unregulated. The SEC's past actions against Coinbase and Binance, including lawsuits, fines, and delisting threats, show that even in the US, regulatory comfort can vanish overnight, all right? Fourth, Bitcoin's ESG footprint remains a reputational risk. I couldn't care less, but some people actually care about this. Bitcoin mining consumes around 150 terawatt hours of electricity annually, according to the latest Cambridge data, all right? So that's more than some countries use. For companies with strong ESG mandates, which includes about 60% of S&P 500 firms, this can be an absolute deal breaker, all right? Tesla, for example, faced heavy backlash in 2021 over its Bitcoin holdings and eventually walked them back, citing environmental concerns. Even improvements in renewable energy use and mining efficiency, the narrative persists, and for reputation-sensitive sectors like finance, retail, or consumer tech, it's a real obstacle, okay? Obviously not for us, but for these guys, all right? Finally, there's a risk of corporate sell-offs triggering the market declines. Imagine this. Bitcoin enters a bear market, prices fall 30%, and several companies that bought Bitcoin for PR purposes decide to cut losses and exit. That kind of coordinated selling, say 100,000 Bitcoin to 150,000 Bitcoin, could depress prices another 15 to 25%. Good for us holding cash on hand to buy this, but that's according to book depth data and daily exchange volumes, okay? We've seen this play out before. When Tesla offloaded 10,000 Bitcoin in 2022, Bitcoin dropped roughly 10% over several weeks. Now multiply that across dozens of companies holding much larger sums. And it's not just about size, that's what she said. It's about conviction. Firms like MicroStrategy or Block are likely to hold through volatility, but companies like GameStop or Rumble, who've added Bitcoin in 2025 with smaller allocations and a marketing slant, may not have the same staying power, all right? That creates a risk not just for price, but for Bitcoin's public perception. If corporate holders are seen as fair weather allies, their actions could erode trust during critical moments. As you can see, the risk of corporate Bitcoin reserves are very real, but that doesn't mean the trend should be dismissed. It means we need to understand who's buying, why they're buying, and are they prepared, and are they able to weather a storm, which guaranteed most are not, all right? So next, we'll look at exactly the different types of companies getting into Bitcoin and what this means for crypto users and enthusiasts. If you're a long-term Bitcoin believer, corporate adoption can feel like validation, and in many ways it is, but it's important not to get swept up in the hype, all right? That goes with anything in life, all right? Let's break down what this trend really means for crypto users and how to separate the signal from the noise. First, let's look at the type of companies jumping into Bitcoin. The serious players tend to fall into 4 different categories. 1, tech-forward firms like MicroStrategy and Block, companies with strong balance sheets, visionary leadership, and clear Bitcoin thesis. MicroStrategy alone holds 597,000 Bitcoin, worth over $55 billion, and has built its brand around Bitcoin as a strategic asset. These are the high conviction holders most likely to weather a bear market. But there's still risk there, obviously, as I've covered in the past. Number 2 is crypto native companies like Mara Holdings and Coinbase, already deeply embedded in the ecosystem. For them, holding Bitcoin is both symbolic and operationally logical. Mara, for example, now holds 50,000 Bitcoin as part of its broader mining and infrastructure strategy. Number 3, we have small to mid-sized companies with high risk tolerance, like Fathom Holdings and Semler Scientific, looking to hedge inflation, attract attention, or explore crypto treasury diversification. Their allocation tends to be smaller, but in some cases, they represent a significant portion of the company's total assets. And finally, firms based in inflation-prone regions, Mercado Libre in Argentina, which is a great example. With local currencies collapsing, Bitcoin has become a way to preserve value amid chaos. That's not just there, but it's globally right now. But there's a 5th category, marketing-driven adopters. These are companies like GameStop, Rumble, LQR House, and Thumbs Up Media, who announced Bitcoin purchases in 2025 with a lot of noise but relatively small allocations. For them, Bitcoin is often more of a branding tool than a core treasury strategy. And so, when you see prices dropping or crashing, they're probably going to sell. But this isn't necessarily a bad thing, all right? So any demand can help support price, but these are the companies most likely to panic sell or abandon the strategy when the market turns. And it will turn. Now, as crypto enthusiasts, we need to be able to spot the difference. So how should we, as Bitcoin believers, long-term value approach this trend? The key is to balance optimism with caution. There's plenty of good news here. Corporate adoption increases Bitcoin legitimacy. It puts Bitcoin on the radar of institutional allocators and even governments. The post-halving supply squeeze combined with ETF inflows, $43 billion in Q1 2025, and the creation of the US Strategic Bitcoin Reserve all signal structural demand that wasn't there just a few years ago. But let's not pretend there are no risks, all right, guys? At a high concentration of Bitcoin with a handful of companies, especially those using centralized custodians, creates single points of failure. Regulatory risk hasn't gone away, and we've seen what happens when hype-driven players are forced to unwind positions during downturns, and it's going to happen again, all right? So the best thing crypto users can do today is stay informed. Know who's holding what. Watch how these companies talk about their strategy. Are they in it for the long haul, or are they in it for the short run or chasing headlines? And here's a quick snapshot to help you get your bearings. All right, as of 2025, approximately 134 to 145 companies are holding Bitcoin on their balance sheets. Altogether, they control about 855,000 Bitcoin, nearly 4% of the total supply. MicroStrategy remains the largest corporate holder by far with 547,000 Bitcoin alone. Mar Holdings with 50,000 Bitcoin, Block with 8,000 Bitcoin, Tesla with 11,509 Bitcoin, and both Hut 8 and Coinbase, each holding around 9,000 Bitcoin. Metaplanet has accumulated 4,500 Bitcoin, while Semler Scientific holds 1,273 Bitcoin. These figures are sourced from Bitcoin's treasuries, CoinGecko, and recent Standard Chartered reports from June and July 2025. So what is the verdict? The rise of corporate Bitcoin reserves is undeniably a powerful vote of confidence in Bitcoin's legitimacy. It's fueling demand, strengthening liquidity, and slowly pushing Bitcoin deeper into the mainstream financial system. But with that comes a shift in dynamics, one that isn't entirely risk-free. Volatility, custodial centralization, ESG scrutiny, and regulatory uncertainty all remain very real threats, not to mention the possibility of panic-driven sell-offs from companies that were more interested in headlines than long-term conviction. That actually gets me excited because people learning crypto.com are going to score when we buy the dip. All right, but crypto enthusiasts should absolutely recognize the upside here, but we should also stay sharp. Celebrate companies that show real commitment, but don't blindly trust every brand that throws Bitcoin in the press release, okay? Stay informed, track corporate wallets, watch for shifts in regulatory tone, especially after the next US administration in 2029. And most importantly, stay true to the ethos of the space, transparency, decentralization, and resilience, okay? If you found this breakdown helpful, you will find even more deep dives like this over at learningcrypto.com, where crypto education goes beyond just the hype. And you get to see what we're buying, when we're selling, and how we're gonna play out the next bear market, because it's coming. Talk to you soon.